Welcome to the deep dive. Today, we're going to be looking at Supreme Facility Management Limited. This company that's getting ready for an IPO, and you've provided a ton of info, prospectuses, financials, the whole nine yards, and looks like you really want to understand this company before you even think about investing.
Yeah, that's a smart move. IPOs can definitely be exciting, but you really got to understand the company before jumping in. So let's dive into these documents and see what we can learn about Supreme Facility Management Limited.
Sounds good to me.
Yeah.
First things first, though, what does this company even DO? I mean, integrated business services, it's pretty vague.
Yeah, you're right. That is pretty broad. Think of them as a kind of like a one-stop shop for businesses in India that want to outsource all those necessary but not really core functions.
Okay, so what kind of services are we actually talking about here?
Their main thing seems to be facility management, like keeping offices and workspaces running smoothly. They handle everything from basic cleaning and maintenance to more specialized stuff like pest control, facade cleaning, even plumbing and electrical repairs.
So like if a company's AC breaks down or their office needs a deep clean, Supreme Facility Management Limited is the one to call.
Exactly. But they actually go beyond just the physical space. They also offer staffing services for support functions, employee transportation, and even like corporate food solutions. They're really trying to simplify things for their clients.
Wow, it sounds like they've thought of everything. The documents mentioned they've been around since 2005 and are focused on corporate clients across India. So this isn't some brand new startup, is it?
Nope, they've definitely got a solid track record, which is usually a good thing for potential investors.
Hmm.
But this IPO would be their first time on the public market.
All right, now to the part that probably matters most to you, growth and expansion. Supreme Facility Management Limited seems to have big plans for the IPO funds.
Absolutely. They've allocated a big chunk of it for working capital, which is essential for managing day-to-day expenses, especially since they often have to pay for services before their clients pay them.
So they're making sure they have enough cash to keep everything running smoothly.
Exactly. They're also looking at inorganic growth through acquisitions. They've used this strategy before and see it as a key way to expand what they offer or move into new markets.
And then there's the general corporate purposes allocation, kind of like a miscellaneous category, right?
Yeah, but there are definitely limits on how much of the IPO money they can use for that. Most of
Wow.
it is already committed to specific initiatives.
So this basically gives you, as a potential investor, a peek into their priorities and how they plan to grow. But what about their track record so far? Are they actually good at what they do?
Well, one thing that really stands out is their 85% customer retention rate. That's insanely high for the facility management industry, which is known for being pretty competitive. This suggests that they're doing something right to keep their clients happy.
85% is definitely a strong vote of confidence. What do you think is contributing to that?
The documents highlight a few things. They have a pretty robust in-house recruitment process, which means they don't use external agencies for staffing.
Yeah.
This gives them more control over who they hire, making sure they find people who fit their culture and meet their quality standards.
So they're investing in finding the right people, not just filling positions. Makes sense since their business relies on their workforce.
Exactly. And they've also been recognized for their commitment to quality management, environmental responsibility, and workplace safety with a whole bunch of ISO certifications.
Those aren't just pieces of paper. Those certifications mean they're serious about running a responsible and efficient operation.
Absolutely. It's all part of the bigger picture.
Okay, time to talk numbers. What about their financials? Are they actually profitable?
We'll get into the specifics in part two, but from a high-level view, their financials look pretty healthy. They've shown consistent revenue growth over the past few years. Their EBITDA and PAT are strong, which means they're making a profit and managing their finances well.
So they're bringing in money, A&E making a profit. That's a good start.
Yeah, but like with any investment, there are risks to think about. The prospectuses do a good job of outlining these.
Let's talk about those.
Yeah.
What are some of the major risks facing Supreme Facility Management Limited?
Well, one is competition. The facility management industry in India is pretty crowded, and they're up against both existing companies and new ones. They have to constantly work to win and keep clients.
So no resting on their laurels. They need to keep innovating to stand out. What else?
Another risk is that they rely on a few major clients. Losing even one or two of those could really impact their revenue.
It's good that they know this and are trying to diversify their client base as they grow.
Absolutely. And then there are always regulatory changes. New labor laws, environmental regulations, and other legal stuff could impact their costs and how they operate. They need to be flexible and adapt to new requirements.
So they need to keep an eye on the regulations and be ready to adjust if they need to. Anything else?
Finding and keeping good employees is a big one. It's crucial for their business, but it can be tough, especially as they grow. They'll need to offer competitive pay and benefits to attract and keep the best people.
That makes sense. Their success depends on having a great team in place.
Right. These risks are important to acknowledge, but it's also worth noting that Supreme Facility Management Limited knows about them and are taking steps to address them. They're not ignoring the challenges.
This has been a great overview of the company. We've covered their business model, their growth plans, how healthy their finances are, and some of the risks involved. But we've only just scratched the surface.
In part 2, we're going to really dive deep into their finances and analyze their performance. Then in part 3, we'll wrap things up and explore some of the interesting details that make Supreme Facility Management Limited stand out.
Sounds good. So there's a lot more to uncover. Stay tuned for part 2. All right, welcome back. We get a good overview of what Supreme Facility Management Limited does and what they're planning for the future. Now let's dig into those financial statements.
I'm ready. Let's do it.
Perfect. So when you're looking at a company's financials, what are the key things you focus on? Where do you even begin?
For me, it always starts with revenue. Is the company growing their top line? Are they bringing in more money each year? That's kind of like the basic sign of a healthy business.
So how does Supreme Facility Management Limited look in terms of revenue growth?
Well, their revenue from operations has been going up pretty steadily over the past few years, which is a good sign. They reported revenue of about 23,601.13 lakhs for the fiscal year ending March 31st, 2022. Then the next year, it jumped to 32,958.74 lakhs. And for the year ending March 31st, 2024, it hit 35,538.67 lakhs.
Wow, that's a pretty big jump, especially in just a couple of years.
Yeah.
What's driving that growth? Is it just luck, or is there something more to it?
It's definitely not just luck. Their growth seems to be coming from a few different things. They've been strategically expanding what they offer, going into new areas like employee transportation and corporate food solutions. They're not just sticking to basic facility management.
So they're diversifying their revenue streams, which is usually a good sign for investors.
Yeah.
It means they're not totally dependent on one part of their business.
Exactly. And they've also been expanding geographically, reaching new clients in different parts of India. This expansion into new markets is definitely helping their overall revenue growth.
Okay, so their revenue is growing. That's a good start.
Mm-hmm.
But revenue is only part of the story, right? What about their profitability? Are they actually making money?
That's the million-dollar question. It's one thing to bring in revenue, but if a company isn't making a profit, it won't last. We got to look at their earnings before interest, taxes, depreciation, and amortization. EBITDA and also their profit after tax, or PAT. These numbers give us a better idea of how profitable they really are.
Okay, break it down for me. What do their EBITDA and PAT look like?
So for the fiscal year that ended on March 31st, 2024, their EBITDA was 2,871.34 lakhs, and their PAT for that same period was 794.82 lakhs.
Those numbers sound decent. But honestly, I'm not really sure what they mean for their overall business. Can you put those into context for me?
Sure. Remember, EBITDA basically tells us how much money a company is making from their core operations before we consider things like financing costs and non-cash expenses like depreciation. It's a good way to see how well they can generate cash from their everyday activities.
So a good EBITDA means they're doing a good job managing their core business and making a profit from what they do. What about PAT? How does that fit in?
Pay it, or profit after tax, is the bottom line. It's the net income they've earned after all the expenses, including taxes, are taken out. This is the actual profit they made during that time.
So PAT is like the real money they've made after everything's accounted for. Looking at both EBITDA and PAT gives us a fuller picture of their profitability.
Exactly. In this case, Supreme Facility Management Limited's EBITDA and PAT, along with their steady revenue growth, tell us they're running a profitable and well-managed business.
That's good to hear. But even with good revenue and profitability, we can't forget about cash flow, right? How well a company manages its cash is really important for them to survive in the long run.
Absolutely. Cash flow is like the lifeblood of any business. It's all about the money moving in and out. A company can look profitable on paper, but if they're not managing their cash well, they can still have problems. We need to look at their cash flow statement to see how they're handling this.
Okay, let's look at that cash flow statement. Where do we even start with this thing? It can be a little intimidating.
It can seem that way at first, but it's not really that complicated. The cash flow statement basically breaks down the company's cash flow into three main parts: operating activities, investing activities, and financing activities.
Okay, let's go through those one by one. What falls under operating activities?
Operating activities show the cash flow that comes from the company's core business operations. It's the cash coming in from customers for their services and the cash going out to suppliers, employees, and other operating expenses. Basically, it's the cash flow from their day-to-day business.
So it's the money they're making and spending from actually doing those facility management and other services.
Yeah.
What does their cash flow from operating activities look like?
Their net cash flow from operating activities has been positive these past few years, which is a good sign. This means they're making enough cash from their core operations to pay their expenses and still have some left over.
That's definitely reassuring. It means they're not just burning through cash. What about investing activities? What's included in that category?
Investing activities are all about cash flows related to buying and selling long-term assets, like property, plants, and equipment. It also includes investments they make in other companies, so it basically shows how they're investing for growth in the future.
So this category shows us how they're using their cash to build for the future, like buying new equipment, expanding their facilities, or even acquiring other businesses. What can we learn from their investing activities?
Their cash flow statement shows they've been investing in fixed assets, which is pretty normal for a company that's growing. They're expanding, so they need to invest in things like vehicles for their transportation services, equipment for their cleaning and maintenance work, and maybe even new office space as they get bigger.
It makes sense that they would be investing in their infrastructure to support their growth plans. Okay, now for the last category, financing activities.
Financing activities are all about the cash flows related to borrowing and paying back debt, issuing and buying back stock, and paying dividends to shareholders. It shows how the company is financing its operations and growth.
So this category gives us a peek into their financial strategy. Are they taking on a lot of debt? Are they issuing a ton of stock? How are they using outside money to fund their activities? What does their cash flow statement tell us about their financing activities?
It looks like they've been using a mix of debt and internal cash flow to finance their growth. They've taken on some debt, which is common for companies in their industry, but their cash flow statement also shows that they've been generating enough cash from their operations to handle their debt payments. They're not too reliant on just one source of financing.
Sounds like they're being responsible with their debt and taking a balanced approach to financing their growth. This look at their cash flow statement seems pretty positive. Strong cash flow from operations, strategic investments for the future, and responsible debt management.
I agree. Overall, their financials look pretty solid. But it's important to remember that past performance isn't always a guarantee of future success. The company acknowledges this in the prospectuses by outlining potential risk factors that could affect how well they do in the future.
Right, no investment is completely risk-free. Let's take a closer look at those risk factors now and try to understand the potential challenges Supreme Facility Management Limited might face. All right, welcome back to the final part of our deep dive into Supreme Facility Management Limited's IPO. We've covered a lot, looking at their business model, how they plan to grow, their financials, and even some of the risks they face. So now let's put it all together and see what we can learn from it.
Yeah, it's been a pretty thorough look, and I think we've got some good insights. Now it's time to kind of connect the dots and see what it all means for you as a potential investor.
So let's start by summarizing what we've learned. What are the key takeaways you think our listeners should remember?
Well, first off, Supreme Facility Management Limited is a pretty well-established player in the Indian facility management market. They've been around for almost 20 years, which shows a good level of stability and experience, and that's often something investors look for.
And they've built up a pretty diverse portfolio of services, too. They're catering to all kinds of corporate needs, from basic stuff like housekeeping and maintenance to more specialized things like staffing, transportation, and even food for companies.
Yeah, they're definitely going for that one-stop shop approach for businesses that want to outsource those essential functions, and their track record so far seems to show that they're pretty good at it.
And we can't forget that 85% customer retention rate. That's pretty impressive. It really shows that they can deliver quality services and build strong, lasting relationships with their clients.
Absolutely. And their financial performance is pretty solid too. They've been growing their revenue steadily over the past few years, which shows they're looking to expand. And their EBITDA and PAT margins are good, meaning they're not just bringing in money, but they're managing costs well and making a good profit.
And they're not just sitting back and watching things happen either. They're actively looking to grow, both organically and by making smart acquisitions. And they're using this IPO to help fuel those plans.
It's a pretty classic growth strategy, and it seems to be working for them. But like we talked about in part 2, no investment comes without risk.
Right. We got to be realistic about the potential challenges they might face. The facility management industry in India is super competitive, and they're going to have to keep innovating and stay ahead of the game to keep their advantage.
And they do rely somewhat on a few big clients. And while they're trying to get a wider range of clients, losing even one or two of those big contracts could really affect their revenue.
And then there's always the changing regulations in India. New labor laws, environmental stuff, and other legal changes could affect their costs and how they operate. They got to be adaptable and ready to adjust to those.
Oh, and like any business that's all about services, finding and keeping skilled employees is going to be huge for them. They'll need to navigate a potentially tight labor market and offer competitive wages and benefits to keep their employees happy and productive.
So there are definitely risks involved, but it seems like Supreme Facility Management Limited is aware of these challenges, and they're being proactive about trying to deal with them. They're not just ignoring the problems.
Right, they're showing a good level of awareness and strategic thinking, which is encouraging. But in the end, the decision of whether to invest in their IPO is up to you. You got to weigh the risks and the potential rewards.
These documents have given us a lot to think about. But you, as a potential investor, you really need to go beyond these materials and do your own research. Don't just take our word for it.
Exactly. Compare Supreme Facility Management Limited to their competitors. Look into their financials, their market share, their growth strategies. How do they stack up against the other companies in the industry?
And don't just stick to the numbers. Go deeper into the facility management sector in India. What are the big trends? What are the challenges? What's the outlook for the future of this industry?
And think about the bigger economic picture, too. How might things like inflation, interest rates, and government policies affect Supreme Facility Management Limited's business? It's all connected.
It's about putting all the pieces together, gathering as much information as you can, and forming your own informed opinion.
And maybe the most important thing is to think about your own investment goals and how much risk you're comfortable with. Are you looking for quick gains or long-term growth? Are you okay with higher risk investments that could have bigger rewards, or do you prefer to play it safe?
Your personal situation and financial goals should guide your decision.
Now, before we finish up, I want to highlight a few interesting things that we haven't really talked about yet. Things that really stood out to me when I was looking through these documents.
Oh, I love those little extra insights. What caught your eye?
Well, their focus on in-house recruitment really impressed me. They handled the whole process themselves, from finding candidates to looking through resumes to doing interviews and making the final hiring decisions. They don't use any outside agencies.
Wow, that's a big investment of time and resources. They must see it as super important for their success. Why do you think they make this such a priority?
I think it shows a real commitment to quality and a belief that their employees are their biggest asset. They're not just filling empty spots, they're carefully choosing people who fit their culture and values, people who will maintain their high standards for service.
That makes a lot of sense, especially since their whole business is about providing services through their employees. The quality of their workforce directly affects the quality of their service.
Another thing that stood out to me was how they focus on building long-term relationships with their clients. They're not just chasing quick contracts. That 85% customer retention rate really shows that this approach is working.
It's a smart strategy. Building trust and loyalty with clients not only leads to repeat business, but also gives them a chance to offer more services and strengthen those relationships over time.
And lastly, I was impressed by how committed they are to quality management, environmental responsibility, and safety in the workplace. You know, all those ISO certifications they have, those are proof that they're dedicated to doing things the right way, both for their clients and their employees.
It's about going above and beyond the basic requirements and aiming for excellence in everything they do.
Exactly. It shows that they're not just focused on making money, but they're also trying to operate in a responsible and sustainable way.
This deep dive into Supreme Facility Management Limited and their IPO has been really informative. We've looked at their business from all angles, and now it's up to you, our listener, to take this information and make your own decision.
Remember, investing is a journey, not just a destination. It takes careful planning, thorough research, and a willingness to embrace both the risks and the rewards.
But with the right knowledge and a thoughtful approach, it can be a really rewarding and enriching experience.
Thanks for joining us on this deep dive. We hope we've given you the insights you need to make confident investment decisions.
Happy investing!